Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, May 5th, 2021. We're going to do a quick overview and some levels to watch on the markets, and then update on a couple of the trade ideas highlighted recently. I'm going to hit on wheat, natural gas, crude oil, Ethereum, Treasury bonds, and gold, and I'll try to keep it in that order in case you want to skip ahead. All right, let's start out here with the Qs. So this morning I posted, well, to kind of recap, if you're catching up, for the last couple weeks here, I've been highlighting this level. That's about 334 right there, that yellow line, as an important support level that would most likely trigger a correction in QQQ if taken out, if and when taken out, and the when was most likely because we had the divergence here. So we got it yesterday, we gapped down below it, biggest drop in months, went down to hit, as I was doing the video I highlighted, we were right here yesterday on this gap support. That gap support is defined by this gap right here. That's a gap from April 1st to April 5th, so we must have had, that must have been a holiday weekend in there. And rally back up, and so the buyer stepped in. A gap is a natural place. I still favor a move down, another thrust down to this level right here. That's a big support level. That's also my minimum pullback target for this correction that we are at least apparently in. It's not a anything big yet. Let's measure it out. Again, the primary trend remains bullish, and it's been, the dip buying has been aggressive for months, although the momentum has waned. So that's been about almost a 5% drop so far off the recent highs from the 29th of April right there, and that's what we're looking at. So I laid out a bounce target zone right here this morning. This is the bounce target zone. This shaded box runs from where we were in pre-market, which was about 332 right here, up to about 336, and that is the top of yesterday's gap. Again, I'm rounding these numbers off by a couple pennies, and they are even numbers. So we got 332 to 336 as a bounce target zone. So far, rejected at the minimum, at the bottom of that bounce target zone. That's where, like I said this morning, objective area to start adding back any short exposure if you took longs there or you didn't have any shorts, or if you are a long, if you went long there and you want to take profits on a quick bounce trade. Either way. And what a bounce target zone means is we're most likely to turn down anywhere in there. I'm favoring the bottom of that zone, but we could most certainly push up. And if we go up much more above that, then maybe the correction's over. Maybe that's all we get. I'll address it then. It's not a guarantee that we're going to new highs. There are some additional resistance levels, but not much. So again, this is what I favor, and I favor another thrust down. I did add to the comment section below that post I put out this morning with this chart with the bounce target zone that this is a minimum target, that 324, 30-ish level. We could quite possibly see quite a bit more, and so that's it. So the scenarios were drawn like this. We either reverse from that 332 area, which so far we have, but you can't really say it's not anything more than just a little blip. You've got support right here at 330. That's a gap right there, this morning's gap. So there's where we closed yesterday, and we gapped up. Here, I think you can see it here on the video. So these are what I call micro levels, little levels to watch. Levels for an active trader to trade off of. You can sit here and game these levels, intraday. There are also levels to manage positions on. If you want to short, like I said, you can put a starter or full short there. You can short there if we get up to 334 or 336. It's funny how these are almost perfectly round numbers on the Qs. 332, 334, and 336. But there it is. All right, that's that. Trade it as you want. If you're long and you went long yesterday's lows, if you think the market's going to new highs, if you've been waiting for the first pullback, you could put a stop where you bought it, but this is even better support right here. Remember, yesterday that was a gap, and the traders did step in and buy the top of the gap, but the bottom of the gap is not just the other side of it. That in itself would be the next support level, but much more important to me, it's this big level back here. I was watching and highlighting when we were in correction mode after that 12% or so drop. It was where we had failed on every kickback rally, so making that a major resistance level, and then we gapped above it and took out. That was a breakout candle right there, a breakout above there. And so on the way down, it would be very good support. It's a well-defined level. And now, remember on the daily charts, I'm not going to spend any time on the daily and weeklies because I've done that quite a bit recently. I've done the weeklies coverage of the major market leading stocks as well as the indexes from a long-term time frame on the weekly charts. There's certainly the potential for much more. So that would be a tell if we whether we get a reaction there or not. If we break much below 324 and keep going down, then that's going to be longer-term bearish and indicate we may go down quite a bit more. Otherwise, let's just focus on the near term for now and see how this area is handled. And if we get down to 324, so if you shorted this morning at 332, right about there, you're talking about a 2.25% drop. Not bad for an active trader, especially if you were able to recycle out yesterday. The other thing I mentioned here is in that chart I posted this morning, a couple things to note, particularly down here on the RSI. Let me expand the RSI. You can see, I know there's a lot of lines on this chart, but what stands out the most is this purple line. It's about 79, almost 80, is an extreme overbought level. What I mean by that, well, overbought on the RSI is typically considered anything 70 or above, but you can see QQQ, at least in recent months, can get really overdone here, and that seems to be about the peak, if you will, on the RSI. So what I highlighted, whether it pans out or not, is we hit that level back here, right here, and then we continue to diverge higher. You can see the divergence. And what happened is the RSI put in a lower low right at the 70 level, and that gave us this divergent high right here. That marked the beginning of that 12+% drop right there. The futures fell 13, the Qs in the NASDAQ 100 index itself during regular trading hours, sessions, fell 12%. And so what I had highlighted is that, we had a first leg down, pretty impulsive once the correction started, and then always during any correction you're going to have snapback rallies. And so this one went up to this point twice right here. We hit it. I should say here, let's take off. Well, I have to leave the arrows on so you can see them. I mean the levels, the price levels. We hit that support level, we bounced, we came and tested again, bounced again, but failed right there. Again, the same 324 level, and then the final leg in the correction came. And after that, we had positive divergence, and that set the stage for the end of the correction, the next leg up right here. Bullish divergence on the RSI. And we also, just like then, look at this, we went way below the 30 is typically considered oversold, but I have a line here at about 21, 22 right there, and that's my extreme oversold reading. We hit it then, but the correction didn't end. Remember, that was the first leg down, just like yesterday, right? And then we went on to hit that line again, and that finally ended the correction. So a scenario I drew out, it's just a potential scenario, would be another leg down in the markets that takes out yesterday's lows, and then put in, or at least I'll be looking for, positive divergence. And that would be an ideal scenario for a bull expecting the market to go on to new highs. So just like back then, if we can get that one more thrust down, now it could be more than that 324. Remember, I always say the charts are dynamic, meaning they're constantly changing. So my analysis will be as well. If we head down here, we'll look, do we have the divergence? How do the futures look at the time? How does the S&P 500 look at the time? And then I'll make that decision to, either reverse from short to long if I get there, or hold out for more on the downside, or maybe just cover and sit back and not go long yet. It all depends on how a lot of things look at the time, and not just not just the S&P 500, but also the market leading stocks for one. If you have all those just breaking support at that time or at support, that might influence what I do if and when we get there to that next target. Okay, so that was QQQ for those who trade the ETF, and whether you trade it or not, even if you prefer to trade futures, you should watch the NASDAQ 100 and the Qs, because quite often they hit support, like I mentioned yesterday, gap support. You don't see that gap here on NQ. It doesn't exist because NQ was trading around the clock then. The gaps on QQQ are from the close of one day to the open to the next day. And the only time you're going to see gaps on the futures is over the weekend, typically, when they shut down on Friday and pick back up on Sunday. All right, so that's this is NQ. The big level on NQ that triggered the sell signal yesterday was a break below 13,700 or 13,702 is marked there. Impulsive leg down, and so far a snapback rally. That would mesh with the top of the bounce zone because that's big resistance. It was, to me at least, not huge support, but pretty important near-term support. And support once broken becomes resistance. So if you got there, great. It'd be even better shorting op than right now, but you know, you may not get there, and that's why I give you those, or at least that's why I'd like to identify bounce target zones and start getting back into shorts at the bottom of the zone. And if I have a little dry powder, maybe I'll add, you know, if and when we get up top, depending on how things look. But we may never get there. You know, it's not market. Mr. Market doesn't always make it that easy and give you these obvious entries. Just like yesterday, you had a act quick on the breakdown at the open on QQQ. If you waited, you know, an hour or so, you missed out on the bulk of the drop. All right, so that's it. Little kickback rally, impulsive leg down. Is it bull flagging action? Or, I'm sorry, bear flagging action? Possibly. You know, bear flag consists of three components: an impulsive move down, followed by a consolidation, upward consolidation that roughly takes the form of a flag, followed by an impulsive breakdown of the flag and another impulsive leg down. The measured target is equal to the distance of the flagpole added to the top of the flag. And so that would take us somewhere down in here. But this is the big, you know, my minimum target zone and big support zone on NQ, because that's that comparable level where the Qs were failing at every attempt during the last correction until they finally broke out right here and gave us a buy signal. Okay, and as impulsive as the breakdown was on QQQ and NQ, which helps to validate those sell signals, for a, you know, swing trader looking for a, you know, bigger multi-week you know, short position trend or swing trade, we still don't have the breakdown I've been wanting to see and waiting for on SPY. SPY, my level's 410.39. That is the comparable support to the one that was taken out on QQQ, but SPY never took it out. We basically came for a near test of it, and we're still above there. Now we still have the divergence in place, and as far as you know, managing positions, SPY did have minor support here at 416.68. That was also gap down and triggered a short-term sell signal yesterday there, and we're back to that level now. If you can see it here, I know the numbers are pretty small. I need to make these bigger for you guys. We're currently trading at 416.55, so just basically this is a kickback to resistance so far. There's, you know, we backfilled the gap. You zoom in real tight. There's yesterday's gap. Here, you go, draw a little line, and that's all this is so far, is a backfill. Ideally, and it's not absolutely necessary, but ideally for the bearish case, you want to see the SPYs remain below that, in that gap, and that will and start to see turn down here impulsively. That means it didn't leave any unfinished business. There was a gap, it went in, backfilled it, and if it wants to now, it can continue on down, you know, to the next support level there. Otherwise, an upside break, it's hard to spin as anything but near-term bullish. You know, again, these are little micro level, short-term charts, not the biggest level in the world, but and there's a potential downtrend line if it does right there. Anything much more than that, again, is just going to be increasingly bullish for the near-term case, especially on the S&P 500. But we'll watch the cues. Sometimes, you know, one index will hold up relatively well, and you see the other keep breaking down, and ultimately it will drag the other one down. I'm referring to SPY and QQQ. Those are the two big large cap indexes I like to watch. Now let's flip gears, go over to the small caps. Certainly worth watching. IWM continues to cling to that long-term trend line. I'm referring to the trend line off the March 2000 lows. Nice clean, you know, we have so far, you know, gosh, trying to grab that with a circle tool. 1, 2, 3, almost there, and then 4, and now 5 distinct reactions. So, you know, bulls buy here, you buy pullbacks to an uptrend line. That's trading 101, or bears want to get ready to see a breakdown of that level, solid break, especially a daily close, to short or add to short positions on IWM, with the next target being, or the first target being 205. And then if 205 breaks with conviction, I think we go all the way down to 170. That'd be a much larger correction. But until then, like I like to say, support is support until unless broken. So that is it. You have IWM at primary uptrend line support on the more significant daily chart. That takes precedence over what happens here on the 60-minute charts. Let me look at futures for you real quick for you RTY traders. I haven't done an update there lately. And remember, just like all the other indexes, the big ones, you can trade the main contracts on the futures. The RTY is small cap, Russell 2000 small cap index, or if you want to nibble or scale in or just use a smaller position size because of your portfolio, M is in Mary 2K, the number 2 and then K. That's your Russell 2000 micro or mini futures, one of the two. And it's the same exact price levels as the big contract. It just has a smaller leverage factor. And so I don't know if you can make it out here, but these are the levels I'm watching. I have a pretty decent support here around 222. I have a potential downtrend line here on the 60-minute chart. And so there's your two probably most important levels. Just above the downtrend line is 2264-ish resistance. So a break of 222 would likely open the door to more selling on the Russell 2000 and maybe take us down here. Now remember, if that happens, you don't see it here, but you're going to break down. You have the potential to break, or you will break, that more significant trend line on the IWM daily chart. And of course, on that, you'd want to see a daily close below it. You could break this intraday and then rally back up. So bulls want to see this downtrend line taken out. If so, then the next resistance, 2264, and ultimately you want to break above this previous reaction high. And bears want to see 222 give way, and especially it's getting pretty big. If we took out this previous reaction low right here at 2159, that would be quite bearish in my opinion. And remember, we did put in a divergent high back here, just like we had one back here, and that led to this big drop. That was from top to bottom after that divergent high. That was about almost a 12% drop right there in the Russell 2000. So keep that in mind, that we're just coming off a divergent high here on the 60-minute chart. And you know, if you want to get long bullish, you look for these divergent lows like this and usually get the rallies. Okay, let's move along a little faster here so I can cover everything else I told you I would in the beginning of the video, starting with wheat. Wheat was recently a long trade idea based on you had a positive divergence right here on this 60-minute chart I'm on. We broke out right here above the downtrend line. There was your breakout, and boom, it was really good for a nice run in wheat. Again, bigger picture, you know, if you're a long-term investor, you can still, I think, tuck away a lot of these commodities, you know, where, you know, I was, not, of course, not a lone wolf a while back, but wasn't hearing a lot of buzz or worry or concern elsewhere about commodity. And now it's legit. And again, I've talked about this. Unlike, you know, the Fed is basically not saying these words, dismissing this as a bear market rally, saying they believe these forces will be transitory, just brief. But what's different this time around, and articles are confirming this, and I'm seeing it everywhere, both producers and top-end, you know, retailers, their rate prices are being raised across the board. So we're seeing this inflation actually permeate. Sometimes you get a spike in commodity prices, and the producers, you know, General Mills making cereal, they'll absorb that short term, because in recent years there was a lot of pricing pressure. The consumer wouldn't tolerate price increases, so companies had a much harder time raising prices. This time around, it's happening, and so that makes it different. And then again, I've made the case of the longer term charts are quite bullish for commodities. There'll be corrections along the way, but as far as wheat goes, right here recently warned of a correction if we broke this trend line right here, because we had the negative divergence here on the 60-minute chart. Gave you a pullback target of 715.232. That was hit, and still a secondary target of the trend line, which might get hit. But look at this. Look how well they've come in and bought that level. Again, that was identified in advance, and every pullback for the last week or so here in wheat has been contained at that level. So it just shows you what's going on in these commodities. They're correcting when the charts say they should quite often. Sometimes they'll burn through the divergences, and when they correct, most often it's a correction in time, a sideways correction before the next leg up, more so in price. With that being said, 715, 232 is still an important level, even more important now than it was just minor resistance when I outlined it back here. Now we have more reactions, and you have a trend line. So, if you're long wheat, but you want to know where to keep stops, it should be, I believe, somewhere below that, not too far below the trend line in that 715 level. And again, long-term investors, just hold on and maybe see if we can get the next leg up there. Was wheat natural, and the ETN for that is WEAT. I sometimes forget about the folks that prefer the ETNs. That's what it looks like. And bigger picture was we recently broke out. This was a big breakout right here above these two previous reaction highs. Impulsive thrust up, and we've been consolidating here. Very overbought. That's one reason you're consolidating, but either way, healthy price action so far. And if you get a deeper pullback, re-entry at 650 would be an objective long, or pullback I should say, to 650 would be an objective long entry. And there's our trend line, would look like this. There's our uptrend line. So that could break that trend line, could take us back there to 650, and if so, that would offer an objective long entry with a stop not too far below it. Natural gas, been trading this one in and out. I usually hit and run natural gas, get in, get out. My last trade, and I highlighted here, I got out. I had a target I gave you. We had natural gas as a long, where was it? First saw in the breakout of this downtrend line right here, breakout back test. Then we took out a minor downtrend line, which was, the suggested stop to get out. But then I highlighted again as a re-entry, another long entry here. Once that divergence extended, we put in an even better marginal new low, was a divergent low. And from there, that was this trade. It's been a nice run in natural gas so far. It was about a almost 20% run, 19% or so off the bottom. And I highlighted this trend line, and several pullbacks to that trend line were highlighted as objective long entries. Now we just pulled back to it today, and what I want to say is, was that objective to buy it again? Yeah, and you got a bounce off there so far, but at this point in time, not me. I got out here because we got close on my 310 target. We got even closer there. Effectively, we just hit it. But see this is negative divergence forming, and so my expectation is there's a good chance this trend line will break. And if it does break, it's probably going to bring us back down to at least that 832 level right there. So that would be if you want to short it, target. If you want to go long, potential pullback target or buy target, even to just get a quick trade. Now look, commodity, this is a commodity, and people are buying anything related to commodities right now because they're going up. We could break out and burn through the divergence, so I have to point out a breakout above 301 should be bullish, but again, it's a breakout I'd probably just pass on for the time being as long as those divergences are in place, unless they're taken out. So I just want to point this out for those of you in it. Those are the levels to watch. Yet another opportunity to get out at that $3, 301 target, or 3-ish, we'll call it. And you want to watch that trend line right there for a break to maybe use as a stop loss, or if you're an aggressive trader, take a short on natural gas. Won't go into UNG right now. Better off watching the futures, even if you're trading UNG. Let's move on to crude oil. Crude oil broke. By the time I was putting this video together and we were here and we broke down cents. So I have a sell signal on crude oil, and that one I just shorted because we had a minor uptrend line right here, series of divergent highs. See, we had divergent high, correction, divergent high, and trend line break. And remember, the sell signal isn't a divergent high. A sell signal, divergent high says get ready to short or get out of longs. Your sell signal comes on a break of a trend line or other support. So that was your sell signal. There was your drop. Then you set up a nice clean up trend line. You put in a divergent high. You broke down. Boom. And these are all very profitable trades. Even 3% right there. That little one. This one was twice that at least, but that's a good trade on crude futures. And then wash, rinse, repeat. And keep in mind that that's DH1, DH2, and DH3. Those three consecutive divergent highs make just one bigger divergence. Okay, so that sets the stage for a potentially much bigger correction. Yeah, this is a commodity. Yeah, I'm longer term bullish on commodities, but this one This would mesh with a correction more downside in the stock market. Crude's highly correlated with the stock market, and this could potentially take us down to some of these deeper targets. My minimum target right now, I might have to revise that. That was a level I've had on here. I'm going to actually move that line right now. Yeah, let me do that and just tell you that at this point in time, this is where I'm looking for a move down to 62.73. So that's still from where we're at. If it's hit, that's still about another just right about 4%, almost a 4% drop to their minimum target on crude, with a stop just above the recent highs there. And for ETF or ETN traders, technically the crude products are usually ETNs most of the time, depends on which one. USO is an ETN. Right there is a pretty significant level back there. We're well past at 31.76, but this is also resistance here around on the daily chart, 42.27. So also a case can be made there where crude's at resistance. And this is what the 60-minute chart looks like. This is comparable to the little trend line I just showed you on the 60-minute chart of the futures. And there was our previous trend line. There was one there. And so there's the breakdown right there. And when I zoom out here on the 60-minute chart, we could come all the way back to here. Let me give you two targets for USO. Right there, 41.68, cover a little bit above that. That's the actual support level. Or hold out. I think we might be able to get down here to about 39.54, especially if the stock market takes another leg down. So there's your targets on crude. There's your divergence right there. DH1 right here, DH2, and divergent high 3. So nice divergence on the 60-minute chart of USO, PPO as well. And so down we go. I'll give you one more target right there. There's a nice support level as well. Right about 43. So that's for you, crude oil for you. SCO, if you don't short or can't short, SCO is an inverse ETF or ETN for crude oil. This is a 60-minute chart. There's a downtrend line that hasn't been taken out, but you get decay in these leverage ETFs. I believe this one's 2-time leverage, if I'm not mistaken. So you really want to trade using the charts. Even if you're going to buy this to short crude, you go long, but you want to use the charts of crude futures ideally, and if you can't, at least use USO, because USO is non-leveraged, and therefore you don't have the decay that you get in these over time. It distorts the chart. Okay, ETCG, that's where my focus has been for cryptos and longs recently. I believe Ethereum, and from what I'm hearing, is the new Bitcoin. Bitcoin's kind of getting the trade's not a little bit long in the tooth, but from what I hear, I talk to people that are all into this crypto stuff. It's not my cup of tea, but I'll trade anything with it. And this one you can buy it, this ETF like proxy for Ethereum. It's ETCG. I mentioned that as a long trade idea on a breakout above 22.44 recently, which was resistance. We broke out there. We had several back tests, giving multiple opportunities to buy on the back test. And as I mentioned, it was up, it's up as of through today about 214% if you took it on the breakout just a couple weeks ago or any of the back tests recently. And so we took out that 48. I pointed out that we'd had divergence heading into there, but the divergence has been since burned through. And this is typical. This is a strong trend and a lot of buzz on these cryptos. I believe I'm in the camp with some, maybe I'm old school, but I believe that sooner than later, the government, U.S. government, other nations, especially those dependent on their fiat currencies, the euro, everything else, they'll in one way or another ban or nip these. They'll neuter these because it's a threat to the dollar. I mean, those of you that study history, and if you don't, you might not be familiar. The U.S. banned public ownership, private ownership of gold back in the 30s for the same reason. It was during the Great Depression. They were printing money like crazy. Bonds weren't worth crap. Cash wasn't. People were hoarding gold, and the government came out and banned gold. So got to turn it in. We'll give you cash for it. If you don't, you're going to be arrested, and the fines are going to be twice the amount of money that you have hoarding away or that you're owning in gold. And they had to. They had to, or else the dollar would be worthless. Everybody was going back to gold. Plus, gold was also, the dollar was backed by gold back then. I think the U.S. dollar had to have about 40% of its value in actual physical gold. The U.S., for every dollar they printed, they had to have 40 cents, stuck away somewhere in Fort Knox or wherever else they were storing it. So anyway, that happened. That was a thing. And look, sooner or later it's going to be a thing. The way these cryptos are going, and the rate and the amount of money that's being sucked into them is being sucked away from the dollar, and it foils the Fed's Ponzi scheme in the U.S. federal government. We're the only way to print our way to get out of the all this massive debt we're incurring is to print our way out of it, and that's effectively, they call it a strategic or tactical default on the bonds. They're going to print money, and they've been continuing to print money to pay for the bonds and to pay for this massive deficits that we're accumulating. And you can't do it if the dollar isn't worth anything. If everyone's pulling all their money out of the dollar, and I'm rambling here. This is a fundamental rant, and I think they need to do it sooner than later. They're going to have a big problem. Bitcoin. Remember, Bitcoin had that crash back in 2017. Let's see if GBTC was around back then. Yeah, it was. Big drop. Here's GBTC back then, and Bitcoin fell. It doesn't look like much because you're looking at log scaling, but from high to low, that was a 90% drop right here in GBTC. This tracks Bitcoin. Now back then, this ramp up, that was the retail crowd. That was the early stage, the crypto people, those that believed in it and were buying it. But everything that I read and all we know was mostly retail investors. This run up here has been largely institutional investors. In other words, the Fed's sitting back and doing nothing about this, and they're helping to legitimize Bitcoin by allowing corporations, even banks, major financial institutions are now accepting, allowing clients to do this, facilitating transactions. Tesla's taken a stake in Bitcoin. They're going to, take Bitcoin payments to purchase cars. So the Fed's, I think the government's trying to figure out how to get a handle on this, but all I'm trying to say is this trend cannot continue, or more and more people go to this. And the bigger problem is, as I just said, it was one thing to crush the retail investor who's speculating, but at this point, the institutions are now in the game. So when you have pension plans, insurance companies who invest assets in diversifying their portfolio, and other institutions buying into crypto, if the Fed finally comes out, or I'm sorry, not the Fed, or whoever, the coordinated the Fed, the federal government, and announces some type of measures again to curtail or limit the effective use of Bitcoin, it will crash. And if it does, now they have a problem, because we already have, and for many years have had a problem with underfunded pension plans and other things like that in the country. So they need to do something. Either way, Bitcoin's dead money, and Ethereum, look, it goes and goes and goes. It's a momentum trade. I have no more targets. I gave you this target 48, but I also said, look, that's the only target I gave you from 2242, because the chart on this hasn't been around that much. Yeah, Ethereum has been, but I'm trading vehicles here on this site that you can trade through the brokers, or I can trade. I don't have a Coinbase account, nor do I plan on opening one anytime soon. That would be a whole different thing. Speaking of that, I'm going to go on a little tangent here. Coinbase did launch recently, and I don't have a lot of trading history because it just went public. But on the 60-minute chart here, you do have some nice divergences forming, and there's a potential downtrend line. I'm not crazy about the downtrend line, but it could do the trick for a breakout in Coinbase. I think they're going to report earnings soon. I'm not sure when that is. I need to look into that. Okay, quick update on bonds. I still like Treasuries as a short-term trade. We did point out there were some divergences recently, and we've broke that support. We had a little correction, but look, so far higher highs. This is the making. We put in remember, this was a big divergent low right here, and more importantly, I showed you, and I'll get to it again for those that missed it. We had the 30-year Treasury rates run into long-term resistance where I expected a pullback, and so far we've had it. And so from the 60-minute chart, I mentioned this divergent low and then the breakout right here. And again, let me turn off all those, forget about all the lines on the chart. We're making so far higher highs. We need to take out, higher lows and higher highs. That's an uptrend. And we had a pullback and we remained above this previous reaction low so far. So if we can break out above these recent highs, we should hit my next target, which is 132.313, and quite possibly, I think, more. So I'm still, it's a little sliver of my pie right now. That's the 10-year Treasury, and then if you want a little more juice, you trade the 30-year because it's more interest rate sensitive, so the prices go up and down more. There's your uptrend right there. This recent low so far remained above that previous reaction low right here, and you can see we're really crunching between this level right here that we already hit my 159 target. There was our breakout right there in back test. That target was hit several times and it's resistance. So this is a trading range right here we're in. So if you are long the 30-year bond via ZB or TLT, you want to stop somewhat below that 156, 144 support level, or position to break out for a breakout, maybe add to your position or take a position if you don't have one on a break of 159. Stock market correction would certainly help this scenario because you'd probably see a flight to safety should the market just the correction that we just had through to yesterday's lows. If that's it, and we're going to go to new highs and the QQQ and SPY, then that might be it. That might just be a bear market rally in bonds, and we break down and we head down to new lows. So don't get married to bonds if you're in that trade. TYX is your 30-year Treasury bond yield, and this is what I was talking about a couple months. It's been a couple months now. I mentioned it rallying into this big resistance here about 24.16, and that was all these reaction highs right here. We had this little triangle pattern, ascending triangle pattern, and we hit it. And that was the week I highlighted, the week of ending in February 26th, Friday, February 26th. We had 7 weeks where we tested it, and we're starting to roll over. Not by much, but I still think we'll get to this pullback target, a minimum target of this trend line. That's what I'm looking for. And so if that happens, remember this is the yield on the 30-year bond. If the yield goes down, bond prices go up, and that's why I remain still near-term bullish, but longer-term very bearish on bonds. Bonds are probably the worst investment, one of the worst investments I can think for a long-term investor right now. There's very little upside potential and a tremendous amount of downside potential on bond funds over the next, let's say, 5+ years and even longer. I think at best case for the next 5 years, bonds are dead money. If the rates stay around where they are, you'll collect interest, measly interest on what the long-term bonds are paying. I'm talking about Treasury bond funds, safe money funds. And again, the downside could be a secular shift in interest rates. This is, bonds have been in a secular interest rates, that is, have been in a secular bear market since the late 70s, early 80s, and there's nowhere else for them to go. So with the Fed taking rates down to the floor, but up. So when this trend finally reverses, especially if this inflation trade grabs hold and the Fed's behind the curve on it, like I think they are, then you'll be looking at a secular bull market in interest rates, meaning rising rates, which means falling prices. Because remember, this was bullish for bond prices. When rates were falling, the 30-year bond and 10-year bond prices were going up because they move inversely. So that's why this is where I'm looking at best case scenario, rates stay low for the next 5 or so years, and again you're going to collect paltry interest on your bond funds. But if rates start going up, the value in those bonds are going to be dropping. So your bond funds will be losing more in principal than they will be collecting in interest. It's the easiest way to say it. And last but not least is gold. Gold still remain longer-term bullish, believing that we're in a longer-term bull market, and may have, only time will tell, recently right here. That was my bottom of my long-term buy zone, my buyback zone for gold. That this was the end of a correction and an ongoing bull market in gold, and we're hopefully, we'll see, time will tell, off to the next leg up. And so far, I like the action in gold. You know, I mentioned we're going to get a little, well, we did. We got a little correction because the dollar had a reversal. And we took out the trend line, but we hit that 1759 level, which I mentioned right here, would be a pullback target and objective area to buy back into gold. So far, we're above there. But if you look at, just step back for the last few weeks, here's what gold's doing. This is a trading range. It's very simple. You want, if you're long gold or thinking about going long, you want it to remain above 1759.75, give or take. That's the level I have it at. Ideally, break below there is going to be bearish, and there's some levels that it might fall to. Whereas a breakout above 1798.50, we'll call that 1800. Let's just round it up. Should be bullish, and so there it is. So you can either buy pullbacks to that 1759-ish level, and or add to your position on a breakout above 1800. And for the time being, you know, if I'm bullish on gold, I'm bullish on the miners. Same thing. So there's your potential targets. And again, if that was the case, and this was a correction in an ongoing bull market, then we'll be looking for new highs in the gold mining stocks in the months and maybe years to come here. All right, that's it. That's everything I wanted to cover. Long video, but got everything I wanted to out. And let's wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.